All right, let's get started. Welcome everyone to today's explainer lecture. Go ahead and get comfortable. Grab your notebooks because today we're going to completely unpack the accounting cycle of a manufacturing enterprise. Now, I know that manufacturing accounting can sometimes feel like this giant tangled web of numbers and rules, but we're going to take it nice and slow. As your professor today, my goal is to guide you step by step through this. We are going to build a really logical, solid understanding of how an entire factory actually operates on paper. So let's dive right in.
Here's our roadmap for the day. We'll start with an introduction to cost elements, then move on to accounting for materials, payroll, and fixed assets, calculating production and unit costs, and finally, we'll wrap up with sales and business results.
Starting with Section 1, Introduction to Cost Elements, Setting the Stage.
By the end of our class today, you are going to walk away with a highly systematic mindset. We aren't just going to memorize journal entries here. You're going to actually understand the why behind them. You'll master how to account for the materials you buy, exactly how to handle your workforce's payroll, how to calculate the precise unit cost of a product, and how to confidently figure out the final results for the business.
You know, the beautiful thing about production is how elegantly it can be simplified. Think about the ABC garment company making shirts, for instance. To make a single shirt, you really just need 3 fundamental inputs. First, you need the physical fabric and the thread, right? That's your materials and tools, which we track in accounts TK152 and TK153. Second, you need the skilled tailors to sew it. That's your labor, tracked in TK334 and TK338. And finally, you need the sewing machines themselves, your fixed assets and depreciation, residing in TK211 and TK214. I really want you to keep these TK account codes in your head. They are essentially the vocabulary of our factory floor.
Moving right along to Section 2, Accounting for Materials, the foundation of production.
Okay, so a hugely crucial concept here is the Vietnamese Accounting Standard Number 2, or VASO2. It dictates a very strict rule. Inventories absolutely must be calculated at their original cost. But I need you to pay close attention to this because original cost is not just the basic sticker price you see on an invoice. It's much more comprehensive. It includes that purchase price, plus any non-refundable taxes, and literally all the associated cost required to get it to you. We're talking about transporting it, loading it, and preserving those materials until they safely sit in your warehouse.
Let's actually look at how this plays out in practice with a journal entry for buying, say, 5,000 kilograms of steel. Watch closely how the debit, which we call NO, and the credit, which we call CA, have to balance out perfectly. First, we debit our materials account, TK152, for the 90 million dong base purchase price. Next, we separately record the 10% input VAT. But check out that third line. Notice how we debit TK152 a second time for the 2.2 million dong transport cost. We do this to bring our total, true original cost for that steel up to 92.2 million dong.
So I want you to stop and think about this for a second. Why do we add that 2.2 million VND transport cost directly into the materials value on account TK152? Why not just write it off immediately as a regular business expense? Well, it all circles back to the core principle of VASO2 that we just talked about. That transport was absolutely necessary to bring the steel to its present location and condition. Without the transport, you don't have the usable steel. Therefore, it's an inherent part of the asset's value, not just an immediate write-off expense.
Now, once those materials are safely in the warehouse, they obviously don't just sit there gathering dust. We have to issue them for production. And this perfectly illustrates how our accounting reflects the physical reality of the factory. If we pull steel out specifically to build product A, we debit TK621, our direct materials cost account, for 73.76 million. But let's say we take a tiny bit of steel just to repair a broken machine on the factory floor. We definitely cannot charge that directly to product A. Instead, we debit TK627, our general production overhead account, for the 1.844 million. The end purpose of the material completely dictates which account we use.
All right, on to Section 3. Payroll and fixed assets, labor and machinery.
Accounting for your workforce is something you have to get exactly right, and it involves a very precise 5-step process. Step 1, we calculate the total gross payable salary on account TK334. Step 2, the enterprise has to extract its mandatory contributions, which is currently standardized at 23.5% for health, social, and unemployment insurances. Step 3, we also have to deduct the employee's own share directly from their paycheck, which is 10.5%. Step 4, we take all that insurance money and remit it to the state using account TK338. And finally, Step 5, we hand over the net take-home pay to our hardworking employees.
Let's actually walk through the math on a 140 million VND monthly wage bill so you can see how this flows. The calculation is straightforward, but allocating it correctly is the key. That whole 140 million payable salary gets credited to TK334. Then, the company itself absorbs an additional cost. 23.5% of that 140 million is 32.9 million. So we credit TK338 for the enterprise's contribution. Meanwhile, we have to debit the salary account TK34 by 14.7 million. Why? Because that represents the 10.5% we are taking straight out of the workers' gross pay for their portion of the contributions.
Okay, let's shift gears from people to machinery, our fixed assets. Look, over time, machines get old, they break down, and they need to be replaced. When we liquidate old machinery, like maybe a worn-out lathe, we follow a really memorable three-step workflow. Step 1, we write the asset completely off the books by removing its original cost from TK211 and clearing out all its accumulated depreciation from TK214. Step 2, if we manage to sell it for scrap metal, we record that incoming revenue on TK711, which is other income. And Step 3, any cost we incur to dismantle it or haul that old machine away go into TK811, other expenses. Keep this liquidation process in the back of your mind. You're going to see the financial impact of it a bit later.
Next up is Section 4, Production Costs and Unit Cost, the factory floor.
If you take away just one thing about manufacturing accounting today, let it be this. The absolute center of the universe is account TK154, work in progress. I want you to imagine TK154 as this giant sponge. At the end of every counting period, it just absorbs everything. It pulls in all the direct materials from TK621, all the direct labor from TK622, and all that general factory overhead from TK627. Every single one of those costs pools together into TK154. This is how we figure out exactly how much a whole production run actually costs the company.
So how do we drill down to find the exact cost of one single item? We use the unit cost formula, which we call Z. Let's parse out these variables together. Z equals DDDK, which stands for our opening work in progress, basically the half-finished goods left over on the floor from last month. To that we add CPPS, which are the newly incurred costs we just sponged up into TK154. Then we subtract DCK, our closing work in progress, the items that are still unfinished at the end of this current month. And finally, we subtract any scrap materials we managed to recover, Feiyu Tuhoi, to land at our true final total cost.
Let's actually execute this math together so it clicks. Imagine we're doing a small production run of 1,000 units. We started the month with 500,000 in opening work in progress. During this period, we incurred 3.55 million in new materials, labor, and overhead. At the end of the month, we had 350,000 worth of stuff still unfinished, and we also recovered 200,000 in scrap. So let's calculate. 500,000 opening plus 3.55 million new costs, that gets us to 4.05 million. Now subtract the 350,000 closing and subtract the 200,000 for the scrap, and that leaves us with exactly 3.5 million VND as our total production cost. Divide that 3.5 million by our 1,000 units, and our unit cost is a perfectly precise 3,500 VND per product. It's incredibly logical when you break it down.
All right, moving to Section 5, Sales and Business Results, taking it to the market.
Now, here's a reality check. You cannot just declare revenue whenever you feel optimistic about a deal. Accounting Standard VAS 14 strictly outlines 5 mandatory conditions for revenue recognition. You can only put revenue on the books when the risks and rewards of ownership have officially transferred to the buyer, when you have completely lost control of the goods, when the actual revenue amount is certain, when you've genuinely gained the economic benefit, and when your costs can be reliably determined. Think about it. If you ship goods on consignment, the risk hasn't fully transferred to them yet, so absolutely no revenue can be booked.
But when you do finally make a valid, recognizable sale, you have to record the dual entry nature of what just happened. You don't just log the cash coming in, you have to simultaneously log the inventory leaving your possession. Looking here on the top, we record the revenue of 175 million into account TK511 plus the associated output VAT. But right below that, concurrently, we have to debit TK632 to record our cost of goods sold, and we credit TK155 to show those finished goods physically leaving our warehouse, valued at their exact calculated production cost of 103.5 million.
Now, well beyond the factory production line, a business has operational costs.
And it is absolutely vital to clearly separate selling expenses on TK 641 from administrative expenses on TK 642. I see students mix this up all the time. But the logic is clear. Your sales staff, your advertising budgets, your product warranties, and your delivery trucks, those clearly exist to sell the product, so they belong in 641. But the company director's salary, the back office accountants, auditing fees, and printer paper, those are purely administrative overhead to keep the lights on, and they must be captured separately in 642.
And finally, Section 6, determining final business results. Did we make a profit or a loss?
Let's look at the final scorecard, the income statement. From our sales, we actually generated a really healthy gross profit of 71.495 million VND. Looks great, right? But watch what happens as we move down the sheet. Our selling expenses ate up over 31 million. Our administrative overhead was incredibly heavy, draining over 41 million. And remember that old lathe we talked about liquidating back in Section 3? It turns out we took a 7 million VND loss on that disposal. When you subtract all of those operational and disposal costs from our gross profit, we are left with a net loss of 8.6 million VND, which drops right into account TK421.
Which leaves me with a real-world scenario for all of you to ponder. Looking at how those numbers played out, if you were sitting in the chief accountant's chair for Me&Am Furniture today, what specific, actionable cost controls would you propose to management? How exactly would you turn that 8.6 million VND loss into a profit next month? Would you aggressively slash that admin overhead? Maybe delay liquidating old machinery to avoid the immediate hit? I really want you to think critically about this. Because accounting isn't just about perfectly recording the past. It's about giving business leaders the clarity they need to build a profitable future. Thank you all so much for your focus during today's explainer lecture. Review your notes, and I will see you all next time.